Hey, what's up guys, John here. Could you imagine a world where you rent everything? You don't own anything.
You'll own nothing and be happy are conspiracy theories, but they're not. In fact, all of them originated at Davos and from the World Economic Forum's own website. Now, WEF is deleting those.
Go as far as renting even the clothes on your back.
Retail experts say clothing rental services have seen a spike in business.
Well, many people argue that this will be what the future looks like here in America. My position is that instead, there will be a lot of traps being set, millions of which Americans will fall into. The problem is that if you don't stay very, very diligent about what's really happening in the economy, and you're not paying very close attention to all these traps being laid, it could happen to you as well. But if you do pay very close attention to this, and you can see not just the headlines that they're putting out, like I'm going to show you what they're kind of getting ready for, but if you can read between the lines, then you'll be able to pivot and move before everybody else and put yourself in a position to not own just something, own a lot of things. Your home, second home, businesses do extremely well. I'm going to break this down for you. I'm going to show you the facts and show you why I believe a tsunami of problems is going to be coming to the economy. And those that are smart and diligent, they'll rise above. Please hit the like button. Hit the like button. YouTube will share this content to educate other people about what's going on in the U.S. economy. And if you'd like to fix your credit to position yourself for this great wealth transfer of assets we're walking into, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item under credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for Tuesday. Take a look at this. So go ahead and quit your New Year's resolution. Science and social media say you're doing the right thing. This came out yesterday, right? Then you have, why can't I rent a house? The Atlantic. This just came out a couple days ago. Then you have CNN. An affordability crisis is making some Americans give up on ever owning a home. Just came out yesterday. Then Bloomberg. America should become a nation of renters. Then workers overwhelmingly want a 4-day work week on one condition. CNBC or Harvard Business Review, how to actually execute a 4-day work week, December 8th. If you pay attention to these headlines, most of them are within the last 30 days. There's no playbook for this. The CEO cut employee salary by 20% and implemented a 4-day work week to avoid layoffs and save the company. Here's what happened. And so when you start to pay very, very close attention to this, what we've seen over the last couple of years is the conversation of the Great Resignation, telling people that they deserve a lot more and that employees really should be compensated 20, 30, 40% more than what they're presently compensated to offset for inflation. You've seen a lot of these traps and a lot of this divisive behavior between landlords and tenants and employers and employees. But what is really happening? Who's really the big winner? Because there's somebody, pushing this conversation. And I think the person pushing the conversation is going to be the one that controls everything. And so when you look at this, it's shocking. The first quarter of 2023, despite pickup in nominal wages, real annual wage growth was negative in 30 of 34 countries with available data, with average declines of 3.8%. So if you have record high inflation, record high food prices, record high energy prices, and falling real wages, what is this going to mean for the building block of wealth? Talking about home ownership, owning your own property, because many people are investing heavily in real estate or have invested heavily in real estate the last couple of years, thinking that rents only go up. I was at a party, my friend's birthday last night, and I was speaking to a real estate investor, and he was saying, in history, rents only go up. They never, ever, ever go down. They never will go down. And the big question is, how can that be true? How can that be true? How can rents only go up if real wages are softening and everything else is going to increase? People are going to start to prioritize feeding themselves before feeding the landlord. And that's what we're already starting to see right now. And so when you're looking at, in this data, 50-year high in apartment construction, then you have rent occupancy drops to a 10-year low. A 10-year low. At the end of 2023, U.S. apartment occupancy hit a 10-year low according to a report from RealPage Market Analysis. This in part due to an increase in apartment supply not seen since the 1980s. I mean, you look at these rental reductions. Over the past year, through December, rents fell particularly sharply in Florida, Idaho, and Oregon. 9.21%, 5.76%, and 5.08%. Now, granted, this is still a massive increase from what they were in 2019, but what many people don't realize is that insurance, taxes have risen greatly, and borrowing costs and mortgage rates have continued to rise. And so what is this going to mean? It's going to mean problems for a lot of these landlords. And what I believe is going to happen is many of these landlords will not be able to compete as rents continue to fall over the next year or so. And what's going to happen then It's going to be those who have equity, those that have the ability to pivot and move and reduce rents and offering concessions are going to be able to hold on to their properties. And a lot of other people simply aren't going to be able to. Leveraged landlords are in very, very, very big trouble, which is going to tip the economic conversation here. People here in America, a lot of people, they want to own a home. They want to, own a business. They want to be independent and free. But if you have a situation where everything kind of tips over and a mass majority of people go from being in the middle class, at least feeling like they're in the middle class, to, losing everything, it's the demand for social services will continue to skyrocket. And so then at that point, then things are going to really start to change. That's what we're walking into right now. Like, for example, in 2009, rents, many people thought rents increased, but in fact, they actually decreased in 2009. But now, how does that make sense? How would rents decrease in 2009 when a lot of people were losing their homes? Well, a variety of factors happened, but landlords wanted to fill those units, and they wanted to get good tenants that had stable income and stable jobs offering concessions. And the same thing is going to be happening now, except this time is a little bit different, because a lot of people that are losing their jobs over the next couple of years are going to have a harder time finding jobs that are going to be able to compete. Many employers are looking to integrate technology, they're looking to outsource labor and talent. They're looking to reduce their overall overhead and expenses, not hire somebody for $120,000 a year to work from home. It's going to be harder to get those jobs going forward. Why maintaining multifamily occupancy will be tough next year. We are no longer in a rising tide lifts all boats, according to Yardi Matrix. It came out 2 weeks ago or 6 weeks ago. It's going to be tough in the apartment operators to maintain occupancies in a slowing economy, although property fundamentals should hold up in 2024 among a few challenges, according to a new report from Yardi Matrix. According to the challenges, wave of deliveries, limited expense growth, rising mortgage rates, and dealing with more expensive and less liquid capital markets, aka banks and lenders tightening up credit, we are no longer in a rising tide lifts all boats market. The traditional property acquisition pipeline will likely remain stalled through most of the year. So near-term opportunities will be concentrated in a debt investments and providing capital for property restructuring. So when you have $2.7 trillion worth of debt that has to get rolled over the next couple of years, you're going to see a lot of these landlords just simply get wiped out. It's going to be absolutely crazy. Renters are starting to get concessions from landlords again, December 10th. Twin Cities apartment deals are hot as landlords offer concessions, November 28th. You're going to have to pay concession rises. Landlords compete for office tenants, December 14th. Renters offered more concessions, market stabilized, November 20th. Metro Phoenix, renters finding more concessions in apartments. This is happening almost all over the nation, with some rare exceptions in certain markets, but in most markets, this is what is happening. And so when you're paying attention to the actual fundamentals of what's going on in the U.S. economy, it's shocking. 54.2% of all single-family homes are owned by retirees. 54.2%. And this is a huge number. In 2022, about 46% of households reported such savings amount. 26% have $100,000. 26% of retirees have $100,000. Right now, it was reported, Wall Street Journal, that it costs $1,000, just over $1,000 per month, just in inflation for the everyday American. $1,000. So imagine being a retiree on a fixed income. What does that look like? Health insurance, rising taxes and insurance on that property. What does that look like? It looks like problems for a lot of retirees. And a lot of retirees that are walking into these problems are either A, going to list them for rent, or they're going to try to sell them. And then a lot of people that don't have any mortgage, they might try to simply, instead of sell the property, move in with family members and rent out their homes, and they'll be a little bit more flexible on how much they can accept for rent. That's what I think is going to happen in the next couple of years. It's going to ramp up this year, but the next 2-3 years, what we're going to start to see is rents greatly fall. A lot of landlords lose their properties, getting picked up by large corporations and Wall Street investors and smart and savvy Americans that are, going to raise money and invest and buy up these distressed deals during that time. They're going to go out there, buy them. They're going to be able to, offset this, reduced rent. And then I ultimately think what we're likely going to be walking into is an environment where, universal basic income is going to be coming out probably the next couple of years. But it sounds far-fetched. But if you look at, Andrew Yang, what he's been talking about, you look at Zuckerberg, Elon Musk, you look at all these, billionaires, they've been saying this for 5, 6, 7 years. And then you look at the growth in UBI. In 2021, it was only in 11 cities. 2022, 82 cities. It's starting to really spread. So I think that's what we're likely going to be walking into as we start to see massive disruption. Homeowners who held onto a 3% mortgage rate are now becoming accidental landlords. March 13th. You're going to start to see this situation ramp up. Now this started roughly a year ago. People are being, kind of forced into renting out their homes because they were unable to sell them because they bought them at the all-time high. 2021, locked in a really, really good mortgage rate, put 6-7% down, and they don't have the equity to sell the property. And so they're turning into accidental landlords. Houston, apartment owner loses 3,200 units if foreclosure multifamily feels the heat. Short sellers seeing distress emerging in apartments as borrowing costs surge. And then when you start to look at multifamily, this is on Bloomberg, multifamily compared to office, industrial, retail, apartments, hotels, in terms of distress, potential distress for apartments far eclipses the distress in office, believe it or not. Far eclipses it, right? And so when you think about how people buy multifamily, they buy it generally, one of two ways. One, they buy it as a stabilized investment. Maybe the market's already at rent or at market rent, so they just buy it and hold it. But most are buying it speculating that they're going to be able to do improvements to increase cash flow, reduce expenses, and it's basically a speculative play that interest rates aren't going to rise dramatically, and they're going to be able to sell it at a big profit. But what happened, or potentially refinance it and pull out their equity and just simply hold the deal. But what's happening for those that bought it at a stabilized, 5-6% return a couple of years ago as rents fall 5, 6, 7, 8%. Those people are going to be in trouble. What about the ones that are buying it speculating that rents are going to go up 10, 20, 30% in the next year or two? And borrowing costs essentially doubled, or some would even say closer to tripled over the last several years. And that's going to be a problem for them. So you start to look at all these moving parts, these moving dynamics in the market. There's no way in which rents don't come down. We're walking into a real estate market. It's going to be survival of the fittest. So when you start to see all these traps being set in the economy, you hear people say, what, we deserve this. We deserve, cheap housing. We deserve, food. We deserve health insurance. Look, we live in a capitalistic world, regardless of what the media will tell you. That's how the world works. And so nothing is ever free. And anyone says that, here, this is for free, this is just for you, you're the product, right? The same exact thing. Mark Zuckerberg said the same exact thing. So when they're selling you the Great Resignation, they're selling you the 4-day work week, they're selling you, this beautiful life living at home with your VR headset, I personally would look at that again. I would look at it twice before just diving into that thinking it's going to be the best solution. Independence, freedom, having options, being mobile, being able to invest, being able to pivot and move whenever you want. That's what it really comes down to. And the easiest way to do that is understanding what's happening in the economy, really investing in the right businesses or investing in the right opportunities, and being really strategic and being in a position to where you're not leveraged to the teeth in consumer debt to where you can't move. What do you think about this entire situation? Where do you see the real estate market going? Where do you see multifamily going? Drop below, let's have a conversation about this. And if you have big goals, if you have big plans, you're thinking about investing in real estate, maybe you're thinking about buying a business or funding a business, if you have any credit issues, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, click the link in the description just below this video. Schedule a free strategy session for Tuesday. Catch you in the next video.